We care about the gold market, but the world at large doesn't care much about the gold market at all. And it doesn't take very much of a turn in sentiment, given how small an asset class gold is, for gold to do extremely well.
For a limited time, the Austrian Mint and SD Bullion are offering you a Silver Philharmonic buy 19, get one free coin deal. Officially issued by this storied 825-year-old European bullion mint. These famous European silver bullion products come packaged complete in protective sealed Austrian Mint tubes containing 20 coins apiece, or in bulk sealed Austrian Mint cases containing 500 troy ounces in each. These guaranteed 1 troy ounce Austrian Philharmonics are official European legal tender silver coins. Each is comprised with a minimum 0.999 fine silver bullion content. Austrian Philharmonic bullion coins qualify for silver IRAs, making them an excellent choice for tax-deferred, long-term bullion savings. Discreetly shipped, fully insured to SD Bullion customers' doors and non-bank vaults. Don't delay. This free silver Austrian Philharmonic bullion coin deal will end soon.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Rick Rule from US Sprott Holdings. Rick, thank you so much for joining us today.
Pleasure to be with you, Elijah. Thank you for having me on.
All right. Now, I'd like to recap a bit regarding the precious metal markets, because we've seen over the past couple weeks a pullback, a significant pullback in gold and silver. What do you think is the catalyst behind this?
Well, I think let's begin by saying that I think, as opposed to know, I think the catalyst has been a reduction in short-term fear concerning the purchasing power of the U.S. dollar. There was some reaction to the Fed moving away from tightening, and I think that that reaction was responsible for part of the near-term surge in the precious metals price. I think it's important for people to understand that, particularly in the early stage of a bull market, there's lots of toing and froing, which is to say that markets don't go straight up. That isn't the way they work. So I wouldn't suggest that people give it a great deal of consideration, either positive or negative. In the precious metals trade, it seems to me that things take place in 2 or 3 or 4 year cycles. And I wouldn't be overly excited about 2 weeks that are strong or 2 weeks that are weak.
Definitely. And I've heard a lot about, especially in the gold market, there's, a significant resistance point around 1350 or 60. Do you see it going above that point anytime soon? And do you buy the idea that there's that big resistance point there?
I don't know about the big resistance point. Let's start by that. I don't follow markets particularly in the short term. I believe that this year could surprise us to the upside, both in gold and silver, not because I see them being ready to break out, but rather because the expectations that people have for it are so low. It's easy to exceed expectations when people don't have any expectations. For you and I and my clients and your listeners, we care about the gold market, but the world at large doesn't care much about the gold market at all. And it doesn't take very much of a turn in sentiment, given how small an asset class gold is, for gold to do extremely well. We've talked on your show before about the fact that precious metals and precious metals related investments occupy 1/3 to 1/2 of 1% of investable portfolios in the United States. The 3-decade mean is between 1.5% and 2%, which means that if precious metals only reverted to their 3-decade mean, that you could quadruple demand for precious metals and precious metals assets in the United States. The point I'm trying to make is that the $1,360 number to me is interesting from an academic viewpoint. But what really matters to me is the market share that gold enjoys relative to competition like the U.S. 10-year Treasury.
Definitely. And mentioning the U.S. 10-year Treasury, you've talked a lot about how you think the bull market is ending. Now, over the last several months, we have actually been seeing the yield on the 10-year Treasury getting lower. So what is your perspective on that?
Well, that forecast, like many of my forecasts, was early. The truth is that people still regard the U.S. 10-year Treasury as a safe haven. And when people are concerned about equity markets, when they're concerned about Brexit, when they're concerned about a slowdown in Chinese growth or the opaqueness of Chinese capital markets, the safe haven of first resort is the U.S. 10-year Treasury. By the way, I'm not one of those who expects that gold will win the war against the U.S. dollar. I'm just one who believes that gold will lose the war less badly. I know I've used this analogy with you before, but I'll repeat it. Today on my way to work, I drove past Motel 6. And today the sign said Motel 6, $69.95. They used to call it Motel 6 because a room night there cost $6. So if you are thinking that the 2% plus interest rate on the U.S. 10-year Treasury compensates you for the decline in purchasing power of the U.S. dollar over 10 years, I would ask you to consider whether Motel 6 being priced at $70 a night is confirmation or rejection of that sort of bias. And if you agree with me, I think the truth is that people will, over time, divert some of their savings into an instrument that preserves purchasing power over time, like gold.
We talked a lot about last time about palladium because there's been a shortage of palladium, which has caused a huge increase in price. Highs we've never seen before. It's all-time highs. Palladium is now even above the gold price. If we could get an update on this and also kind of looking into what is driving the palladium price, if you can expand on that as well.
Sure. It's fascinating. Remember, and we've talked about this before, most palladium that's produced is produced as a byproduct of other metals, platinum or nickel, platinum in South Africa, nickel in Russia. Neither platinum prices nor nickel prices are strong. So as a consequence of that, not as much byproduct palladium is being produced. Meanwhile, gasoline vehicle sales are in very good shape, particularly in China. So demand for palladium continues strong, but the market isn't responding to the increase in price in palladium because there are very few primary palladium mines. To increase the supply of palladium, either the platinum price would have to go up so that byproduct palladium production in South Africa increased, or the nickel price would have to go up so that byproduct palladium supplies in Russia would increase. As it sits right now, the truth is that the demand continues strong and the supply continues weak. What's particularly interesting to me about the palladium market is that it could, I'm not saying it will, but it could get stronger. Think about this. It takes at today's prices about $170 worth of palladium in a catalytic converter to sell a $35,000 or $40,000 car. Let's say the palladium price went up another 50%. Would it make a dent in auto sales? No. So you have a circumstance where supply is constrained because it's byproduct production that constitutes supply. Demand is strong, and demand is relatively inelastic. A different point on the platinum and palladium subject that I think is interesting is that I'm pretty certain that the pricing difference between palladium and rhodium on the one hand and platinum on the other hand is so great that you will see over 2 or 3 years the development of fabrication technologies that begin to substitute platinum for palladium in some catalytic technologies related to gasoline engines. So one of the outcomes, I think, of the stronger palladium prices will, over the sort of 2-year time frame, be increased demand for platinum as well.
I'd like to talk a bit about the physical demand of palladium impacting the price. So how, if we look at palladium versus other precious metals such as gold and silver, how does physical demand impact the price of palladium?
Well, the nice thing about palladium, I guess from a speculator's point of view, relative to gold, is that it gets used up. Gold comes out of a hole in the ground called a mine, and it goes in a hole in the ground called a vault, which is actually a very strange transaction. Palladium goes out a tailpipe. It goes out an exhaust pipe. It goes to palladium heaven. Yes, some can be recycled as you recycle some catalytic converters. But like silver, one of the intermediate term advantages to palladium's status as both a precious metal and an industrial material is that new mine supply doesn't necessarily increase total investable supplies over time, because so much of it is used up in fabrication applications.
Now, if we do look at the platinum market, as you were talking about, it's interesting if we compare it to gold, because right now it hasn't been this low since about 110 years or so. So what is your perspective on the recent platinum price? And looking just at the relative price of gold, it seems like a steal right now. What is your perspective?
I do believe it's attractive right now. One of the interesting things about turning 66 is that ironically, when you have less time on Earth, you become more patient. And when I think about circumstances that will change over 2 or 3 years, 2 or 3 years doesn't seem like a daunting time frame to me. Ironically, younger people who have longer on Earth tend to be less patient with regards to investment outcomes. Given that platinum has a lot of utility to users, and is cheap relative to materials that it might substitute, I think the probability is that the circumstance that you describe is accurate, that demand for platinum will increase relative to supply. And the same inelasticity of demand exists with regards to price, meaning that in the case of platinum, it takes about $100 worth of platinum to sell a diesel vehicle. If you doubled the price of platinum, I think it would have absolutely no impact on vehicle sales. So what's really interesting about both the platinum and the palladium market is the incredible inelasticity of demand relative to price.
Now, are there any substitutes when it comes to platinum and palladium for like the demand? In cars, can you use other metals except for platinum and palladium?
Well, in theory, I suppose you could use lead or nickel in catalytic applications, but you'd have to use so much of it that in effect you'd be putting your exhaust through a trailer. I mean, the truth is I'm not a materials physicist, but it would be difficult for me to imagine, other than rhodium as an example, one of the minor PGM metals, that there would be other metals that had catalytic properties that were economically efficient.
Very interesting. Yeah, I think we talked about this last time. It does seem like it is such an inelastic demand, right? For platinum and palladium. It's like, yeah, as you were saying, if the price goes up double, it's not really going to impact the demand because it's such a small, they use so little platinum and palladium in the products that they produce.
If your listeners are looking for something to worry about, in other words, if they want to justify their continued procrastination, I would suggest that what you need to worry about is world economic growth. The one thing that scares me is that we're probably 9 years into an economic recovery, albeit a tepid economic recovery. If that recovery is long of tooth, then it could be that you could see economic prosperity waver, and the consequence of that would be vehicle sales waver. That, to me, is the only sort of cloud on the PGM horizon.
Definitely. And getting into the economy, what is your perspective on what the Fed has been doing recently? It seems like the general narrative is that they're kind of they're being a bit more patient, maybe a bit dovish, maybe going to stop unwinding their balance sheet. What is your perspective on and how that could impact the economy?
I think we have a manipulated interest rate. While I think that's bad for the world, I know it's good for me. Low interest rates, if you have credit, are a subsidy to you. So it's ironic that your generation is subsidizing old, fat, rich, bald guys like me. Thank you. It also assists people in capital-intensive businesses, which I'm in. So while I'm a direct beneficiary of the Fed's action, I think it's wrong. I think it distorts markets. It stimulates consumption at the same time that it discourages savings. And the aggregate debt levels that we have in our society at the government level, at the corporate level, and at individual levels, I think are very unhealthy. I think the circumstance that you stimulate consumption, particularly consumption that's been forward shifted, meaning that low interest rates cause people to buy today what normally they would have had to save to buy later, is pernicious, both in terms of the fact that it increases debt levels and it steals real economic activity from future years and front-end loads it now. So I think it's very dangerous. I also think it sends dangerous signals to investors about what the real cost of capital should be. The idea that people are buying equities based on the company's cost of capital that's partly subsidized by very low interest rates, and they are accepting as reasonable dividend yields that are only reasonable if you compare them with the yields on savings products that are artificially depressed, I think turns a whole generation of people who might otherwise be investors into speculators. And I'm not criticizing speculation. All the money that I now invest, I made by speculating. But I came of age in a much more rational market.
Now, if we look at, what the Fed is actually doing right now, do you see it being positive, though, for the economy? Even though you say it seems that it distorts markets, what is your perspective on, do you see the Fed's actions currently as positive for the economy?
Well, to use a somewhat intemperate phrase, if you believe that goosing the economy is good for it, I think you're stimulating the economy. I'm not sure that I think that's good. But I think the circumstance that you're seeing, adding liquidity, makes demand more buoyant than it would naturally be, and also supports equity prices at higher levels than would otherwise be the case. I would prefer, not that anybody cares what I prefer, but I would prefer that people's decisions were based more on fact than on the sort of narrative of artificial liquidity. My real nervousness is, of course, that we're going to have to pay the piper for this. My real nervousness is that the fact that the market's extremely liquid, the fact that there's lots of cash in the system, distracts people from the fact that the body of debt that we're built up means that although we're liquid, we may not be solvent. When ease about liquidity gets replaced by concerns about solvency, you tend to get liquidity-driven bear markets, similar to the one we experienced in 2008. I wouldn't want to see a headline, saying Rick Rule sees 2008 revisited or anything like that. But I think your listeners, particularly the younger listeners, the listeners your age, need to be on guard about becoming complacent as a consequence of liquidity when what they ought to be focused on is solvency. Definitely.
And when we look at these issues in the economy, what is your perspective? Like, if we look at back to precious metals, you were saying, for platinum and palladium, if we're going to see a downturn coming soon, then maybe that's one worrisome, one thing that could be negative for the platinum and palladium prices. Otherwise, it seems like you're pretty bullish on platinum and palladium. But what is your perspective when it comes to precious metals? Kind of the portfolio allocation, or like what precious metals people should be looking at the economy going forward.
That's a really interesting and really nuanced question. A lot of it depends on the investor. If somebody calls me, and as an example, they're my age, the truth is at 66, you need less protection of purchasing power than you used to, because the time value of money becomes less important as you have less time on Earth. The more important question is the efficacy of precious metals portfolios for people your age. People your age are victims of one of the greatest swindles in the history of mankind. My generation made itself all kinds of promises in the form of entitlements. That's why off-balance sheet liabilities in the United States, according to the Congressional Budget Office, exceed $120 trillion. If your viewers want to know what an off-balance sheet liability is, all they have to do is look at me. I'm 66. So all this cool stuff like Medicare, Medicaid, Social Security, all these sort of entitlements, I voted myself, and you all have to pay for it. Now, from my point of view, this is a hell of a trade, but I can understand how your generation might feel aggrieved. What your generation needs to figure out is that all of the promises that society has made to each other, to bondholders, to old geezers like me, are going to be very, very, very difficult to service. And it seems to me that there are two ways out of this coming liquidity problem. One would be a good old-fashioned honest default, where you said either to the bondholders or the old geezers like me, you guys made the promises, you keep them. I'm signing off on this. There would be some interesting political repercussions. The other would be to debase the currency over time, to reduce the net present value of the obligation at the same time that you kicked the can down the road. That's what the generation before me chose to do in the 1970s. They inflated away the net present value of the obligations incurred to fight the war on poverty and the war in Vietnam. And it's going to be an interesting decision for your generation as to how you deal with it. Were I of your generation, I would certainly own some precious metals, because either outcome, that is an overt honest default, or the dishonest default by way of debasing the currency, would, I think, shake fundamental belief in the U.S. dollar and the purchasing power of the U.S. dollar as expressed by U.S. Treasury securities in favor of gold. So the most important portfolio is a long-winded answer. I apologize, but I've been thinking about it a lot. The most important demographic for precious metals investment is precisely the generation that has the least exposure to it, which is to say yours.
No, definitely. I really appreciate the long-winded answer you said, but I think, no, it's very well thought out. And I think that's really helpful for our viewers. And yeah, Rick Rule, thank you so much for joining us today. I guess before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, my normal circumstance, particularly to younger viewers who I am amused talking to, one of the things I like to do to encourage that conversation is to offer up no obligation portfolio reviews. If your reviewers will email me their natural resource portfolios, please with both the symbols and the name in text, so that I don't have to express my inability with technology opening a whole bunch of different attachments. If you email those to me at rrule, R-R-U-L-E, at sprottglobal.com, I will rank the natural resource investments in your portfolio and return them with comments as appropriate, with absolutely no obligation.
Awesome. Sounds good. Rick Rule, once again, thank you so much for your time.
Always a pleasure. Thank you for the opportunity to address your audience.